In this episode, we're going to break down the potentially significant tax benefits of gifting highly appreciated assets to charity. I promised that I would come back to this strategy at several points earlier in the series, and I'm really excited to dive in because this was the first charitable tax planning tip that I ever learned, and it sparked my entire interest in this topic. And I think this warrants a moment to reflect on how far we've come in this series. We started with the foundation, the general differences between tax credits and tax deductions, and that set us up to explore the charitable income tax deduction, then to get us over the hump of limitations imposed by the standard deduction, we explored the concept of bunching and how that concept influenced donor-advised funds, which we covered over 2 videos. We talked about charitable tax planning strategies with qualified retirement accounts, both during life and at death. And if you missed them, I'll link to all of these videos in the description. But I have to admit that this topic is my all-time favorite. The strategy that we'll explore in this episode is one easy way to get a potentially significant tax benefit, even if you take the standard deduction. And it's even more impactful if you itemize. So what do we mean by highly appreciated assets? These are assets that have grown in value from the date that they were purchased. They have appreciated in value. The common example is stock and other marketable securities. So let's cover an example. Let's assume that you purchased Apple stock several years ago for $100. The $100 purchase price is your cost basis in the stock. Assume that it has appreciated in value to $400. If you sold the stock, you would recognize a $300 gain and pay tax on that gain. It's called capital gain tax, and the tax rate depends upon your ordinary income tax rate, but it can be as high as 20% under current rates. For those of you who like formulas, a capital gain is the difference between adjusted basis in the underlying asset and the price at which the asset is sold. With stock, the cost basis is the purchase price. So in our example, the cost basis is $100. If instead of selling the stock, you gifted the stock to charity, you are generally making a gift of the entire $400 fair market value of the stock. Because charities are generally exempt from tax, the charity could sell that stock and retain the full $400 cash generated from the sale and pay no capital gain tax. And you may be eligible for an immediate tax deduction for the entire fair market value of the stock, or $400. There are, however, some limitations that are very important, which we'll discuss later in this episode. If you own appreciated stock and you are charitably minded, this opens up new horizons of potential gifting strategies. For example, assume that you have $200 in cash and $200 in appreciated stock. If your goal is to make a $200 charitable contribution, and maybe you don't really want to sell the stock because you like the stock and you think it will continue to appreciate in value over time, you can transfer the stock to the charity and use your $200 in cash to purchase the same stock at its $200 current value, which then becomes your new cost basis in the stock. So now you've accomplished your goal of gifting $200. You have avoided paying any tax on the appreciation in value, and you've increased your cost basis in the stock so that if you later sell, the capital gain is based upon the $200 cost basis rather than the lower $100 cost basis. So I hope that you can see how much of an impact this can have on your taxes, and it can have a significant impact on the charity. There's also a potential for a double tax benefit. With certain limitations, which we'll cover in a moment, there are two separate potential tax components of gifting highly appreciated property. First, you avoid paying the capital gain tax on the appreciation and value, and you might be able to deduct from your taxable income the entire fair market value of the appreciated property. Now, let's discuss some limitations on gifts of appreciated property. And keep in mind, these limitations only apply if you itemize deductions. First, let's look at the limitation on short-term capital gain property. If the donor held the appreciated property for 1 year or less and the sale would result in a short-term capital gain, only the donor's basis is deductible. You cannot deduct the entire fair market value of the property. For long-term capital gain property, deductions on gifts to certain types of private family foundations are limited to the basis in the property. Finally, we'll talk about limitations on deductions. It is critical to understand that charitable deductions for non-cash contributions, including appreciated property, have certain limitations. Depending on the type of appreciated property and the type of charitable organization, the charitable deduction is capped at 50%, 30%, or maybe even 20% in some instances of a taxpayer's adjusted gross income. So I'll give you an example. For gifts of long-term capital gain property to a public charity, the deductions are limited to 50% of the taxpayer's adjusted gross income if you use the basis as the value, or 30% of adjusted gross income if you use fair market value as the value for determining the deduction. Now, this is a straightforward math problem, but it is extremely important to run the numbers. It's also important to make sure that you are using current limitations. The limits that we're discussing are always subject to change, so please make sure that you're using current limitations in your analysis. So what this means is that you'll want to be mindful of making substantial contributions in low-income years if your goal is to take full advantage of the tax benefits of your generosity. And as a final note, if you exceed the limitations that we just outlined, contributions that exceed the adjusted gross income limits can be carried over for the following 5 years. So you don't necessarily lose your deduction if you exceed the adjusted gross income limits. You can spread it out over time, but it's just an idea and a point to make that if your goal is to take full advantage of the deduction in a single taxable year, you just want to make sure that you're running the numbers to make sure that you're eligible to take the complete deduction. Another thing that's important to keep in mind is that this same concept can be applied to many different types of property, including real estate, for example, which is another common type of highly appreciated property that many people own. Some charities may not be able to accept certain types of property, and some assets may be hard to value for purposes of taking the charitable contribution deduction and for purposes of determining value. In fact, the IRS requires appraisals from a qualified appraiser in certain instances. This strategy of gifting highly appreciated property to charity can have significant tax benefits. And this is good for you from a tax perspective, and it's good for the charity because utilizing these techniques may result in the donor's ability to gift more. I want to thank you for your generosity on behalf of all of the charities that benefit from it. I want to thank you for joining me, and I hope that you like this content. I hope that you find it useful. If you do, please consider subscribing to the channel. That way you can tag along as we continue throughout the rest of this series, and I'll look forward to seeing you in the next episode.